because you got to evaluate, needs of the property, and you've got to evaluate, kind of your investor needs as well. A lot of real estate, if you're the sponsor and you brought on a bunch of GP and or LP investors, you've promised them it used to be a 10% preferred return, then it was 7, then it was 8, then it was 7, 6, but somewhere in there you've got expected like cash on cash return that you need to keep your investors happy with. As far as reserves, I would say historically we probably kept 2 months. We are building a little bit more reserves in our properties right now because we are expecting higher insurance premiums. We have some apartments in Florida, and you're finding, like, on these named storms, our cash outlay if we have damage from a hurricane on a named storm might be $500,000. Now we're not keeping that in a property operating account, but we still have to keep it in reserve, and out of the market so that it's there. And then, we don't have a lot of office, but office right now, generally occupancy is going down. You've got less rental income coming in, but if you've got, a big tenant you want to bring in, you're probably committing a lot more TI than you were 5-6 years ago. So you could easily have, we're in the market looking for new office space for next year, and there's some places that are offering $75-$80 a foot of TIs for a 5-7 year lease. That's office is a lot different than multifamily is, and that can be a big number if you're trying to bring down a tenant that's going to take down 20, 25, 30% of your space.